Welcome to the Raisina Facebook Live sessions. I'm very happy to be here today with Jonathan, who is an executive with the European Bank for Reconstruction and Development, and Geraldine, who's an analyst with the OECD. I'm Kanika Chawla, and I run the Renewable Energy Program as well as the Center for Energy Finance at the Council on Energy, Environment and Water. And today we're going to talk about how do you pay for the revolution, the green revolution that we're seeing at the moment. And I think that the most obvious question that comes to our mind is that there are several institutions around the world that have been set up for the express purpose of financing development. And in the face of the kind of development that we need today, the energy transition is one big development imperative. So Jonathan, maybe to start with you, why do you think that there isn't adequate lending or lending at scale for the green transition in emerging economies from institutions like yours?
It's a very important question, Kanika. I mean, we invest over a third each year of our total investment of 10 billion euros each year into the green economy transition, and we're going to make that close to 40% by 2020. So it's very important for us. We recognize it is not easy to get the private sector to invest in these things. They will go where there is profit. And a key area really for making sure the private sector is attracted by countries is making sure that governments do what they need to do. Governments need to do much more to ensure that the enabling environment is there in countries, that the background is set. That means getting the right regulatory frameworks, setting up the right tariffs if it's about green energy, for example, all the things that private sector companies would expect to have in place if they're to put their money into a country. We see that time and time again, which is why we work very closely with governments to make sure that background is right. Otherwise the private sector won't come. They have many other places they can put their money. Yeah. They're not going to hang around waiting for governments to do their thing. They want to see action, they want to see proactivity, and all too often we see that governments move quite slowly, either because they're bureaucratic, or what we see in a lot of countries as well, particularly in emerging economies, is governments just don't have the capacity, the implementation capacity to do what is really required to attract investment. We have to help them with that.
Geraldine, I know that there's a lot of work that the OECD does with institutional investors, and you of course understand the European market as well as sort of other OECD country markets quite well. What in your experience do you think are the big points of difference that the institutional investors are not coming into emerging economies with long-term, low-cost loans or even equity positions for that matter?
That's a critical question, and it's really the trillion-dollar question that we're talking about here, because on the one hand, we have a lot of investment needs in emerging markets to achieve the low carbon transition, but not only to achieve low carbon, but basic development needs. And on the other hand, you don't have shortage of globally available capital. OECD institutional investors alone manage up to $84 trillion in assets. So there is money available. The question is, how can we reallocate it, and how can we incentivize institutional investors to go into green infrastructure investment in emerging markets? And basically the challenge is threefold. The first thing is that institutional investors don't invest much in infrastructure, period. Less than 1% of large public and private pension funds asset is invested in infrastructure. An even smaller share is invested in green infrastructure, and it's almost negligible for emerging markets. So it's a threefold challenge. And Jonathan rightly pointed that the first and foremost priority is for governments to send strong, predictable signals for investors to invest in each of those countries that have promising potential for green infrastructure, whether through renewable energy, energy efficiency, and public transport, et cetera, electric vehicles. But then the other aspects, once you send, once you improve the profitability of individual project, is of course to create a pipeline of bankable projects. You can't have transaction cost with investors finding and searching for years for the right single project. Right. And then once you have that pipeline of projects, and let's hope that we can get all the countries to commit to strong enabling conditions for green infrastructure, like Jonathan said, then you still need to address the mismatch of capital. And you have a lot of opportunities for institutional investors to increasingly be aware and increase their appetite for such investment. And it's been very promising to see that in Europe and other OECD countries, institutional investors, including asset managers and asset owners, are increasingly aware of climate change risk, and they're increasingly mindful of the risk of stranded assets. Yeah. And they're thinking, hold on, in 12 years, the IPCC report is telling us that we're running out of time. I don't want to wait for 12 years. So
Exactly.
how can I integrate in my portfolio? But then you need some investment vehicles, and you need a lot of matchmaking.
Yeah, so on that point, actually, I think that one of our biggest friends in this energy transition has been innovation, right? So, but when we think about innovation, we're mostly thinking about technology innovation. So maybe we can I'd like to talk a little bit about what is the role of inventiveness, both in how finance is structured, but also regulatory inventiveness and policy inventiveness. And given that you do so much groundwork on the policy and regulatory side before going into some of these countries, do you want to talk about some of the cool things that countries have done to really underwrite risks?
I think that things are really, there's reason for hope. Although things move slowly, I'm optimistic, and I'm optimistic for a number of reasons. One is it's very clear that new financing vehicles, innovation in that area, are coming forward all the time. We're seeing it in terms of some of the green bonds and how they operate. Even if initially, with some green bonds, for example, they can't find enough green assets to invest in, they are starting with what might be described as a brown portfolio and then slowly greening it.
Yeah.
So that's an example of innovation in terms of the approach, accepting that it's a slow process but actually doing something. I think in terms of other areas where we're seeing more and more impact investing, for example, for companies and for funds, that is more and more important. That is bringing money into this area. So two reasons for hope. I think the other reason for hope, we see it on the policy grounds, things can move very quickly when governments understand what they need to do. And to give you an example, Egypt, which had virtually no renewable capacity just 5 or 6 years ago, we worked very closely with the Egyptian government to make sure the right regulations, the right tariffs were in place. Now it has an incredibly thriving renewable industry. Some of the biggest solar fields in the world are in Egypt. And that just wasn't the case 5 years ago. So when government understands what it will bring, they move. We just have to help governments understand.
Yeah. Geraldine?
No, it's very true, like Jonathan said, there's been a lot of financial innovation. You were asking Kanika about that. And green bond is a very successful example. 10 years ago, there was no green bond.
We've just done our fourth, by the way, green bond.
And we hit, world green bond issuance hit 500 billion mark cumulatively, like just a few months ago. So this is very exciting. Then there are many other innovative financial instruments and institutions. For example, several countries and cities and other subnational territories around the world have created what we call Green Investment Bank to help crowd in private sector investment, to help kickstart investment in green infrastructure. There's many other innovative financial instruments, whether helping to standardize financial agreement and power purchase agreement, helping to de-risk investment, helping to pool investment, because some of the green infrastructure projects are very small scale, and typically large institutional investors don't come in for small energy efficiency project or small distributed renewable. But when you pool them and you aggregate them, you can reach the scale that those investors require. That's one example of innovation. We have many other, and that's where development financial institutions and government can play a critical role by helping to leverage private sector investment. And the role, for example, of blended finance amongst the development financial community is critical to help create additional funding from commercial finance. We have many innovative solutions, and I'd say there that what's fascinating to watch in the past 2 years is there's a boom of partnerships between stakeholders and an acknowledgement that governments alone, they are critically important, but they need to partner with all stakeholders, including development financial institutions, international organizations, private investor, project developers, civil society, philanthropies even. And we've heard so many innovative partnerships being announced. And I'll just mention briefly that the OECD is launching a new program on clean energy finance and investment mobilization precisely to achieve that collaboration to unlock clean energy, and through building our network of institutional investors and other project developers and investors.
I think, as Geraldine says, it's crucial that all stakeholders come together. This will require combined capacity if we're to make. Having been optimistic, there is just one note of pessimism I would put in there, that we've been looking at this really over the past few years in the context of a relatively fast-growing global economy. My worry is if we are at the peak at the moment of the economic cycle, and for the next few years we might be in a lot slower growth or worse, with synchronized slowdowns in many markets, that will provide a very different lens, I think, for looking at how this unfolds in future. It will make investors more cautious when they're looking for returns, and that may have an impact on the speed in which they're willing to invest in green economy transition.
But I think just also to sort of pay homage to India while we're here is that when we announced our renewable energy targets, we expected that they would, I mean, we were at 3 gigawatts of solar installed. We wanted to get to 100 in 7 years with capacity doubling every 18 months. And I think that there is also a learning curve of the energy transition that's not just for technology, but also a learning curve for capital, a learning curve on efficiency. And then I think that given that we are well on our way and several other emerging economies are well on their way, surely there will be much more capital flowing into these countries and financing the green transition. So thank you very much for your time.
It's a pleasure.
Thank you very much.